Trading is the process of buying and selling financial assets with the aim of making a profit from price movements, and it has become one of the most talked about concepts in the modern financial world because of easy internet access, mobile apps, and global markets. In simple words, trading means purchasing an asset at a lower price and selling it later at a higher price, or in some cases selling first and buying later when the price falls, depending on the type of market and strategy used. Trading exists in many forms and has been practiced for centuries, but the way it is done today is very different from the past. Earlier, trading happened mostly in physical marketplaces and stock exchanges where traders had to be present in person, but now it can be done online from anywhere in the world using a smartphone or computer. This accessibility has attracted students, professionals, and even beginners who want to understand how money moves in markets and how profits and losses are generated. However, trading is not a get-rich-quick method. It requires knowledge, discipline, patience, and proper risk management to succeed over the long term. At its core, trading is based on the principle of supply and demand. When more people want to buy an asset than sell it, the price usually goes up, and when more people want to sell than buy, the price generally goes down. Traders try to analyze these movements and predict future price direction to make profitable decisions. The assets that are commonly traded include stocks, cryptocurrencies, commodities, currencies, forex indices, and bonds. Each market has its own characteristics, trading hours, volatility, and risk level. For example, the stock market involves shares of companies, while the forex market deals with currency pairs like USD, PKR or Euro USD, and the cryptocurrency market includes digital assets like Bitcoin and Ethereum. Although the assets are different, the basic concept of trading remains the same across all markets, understanding price behavior and making decisions based on analysis and strategy. One of the most important things to understand about trading is the difference between trading and investing. Many beginners confuse these two terms, but they are not the same. Investing usually involves buying assets and holding them for a long period, sometimes years, with the belief that their value will grow over time due to business growth or economic development. Trading, on the other hand, focuses more on short-term or medium-term price movements. A trader might hold an asset for a few minutes, hours, days, or weeks, depending on their strategy. The goal of trading is not necessarily to own the asset for a long time but to take advantage of price fluctuations. Because of this shorter time frame, trading often involves more frequent buying and selling compared to investing. There are different types of trading styles, and each style suits different personalities, time availability, and risk tolerance. One common style is day trading, where traders open and close positions within the same day. Day traders do not hold trades overnight and try to profit from small price movements during market hours. This style requires quick decision-making, strong focus, and constant monitoring of the market. Another style is swing trading, where traders hold positions for several days or weeks to capture larger price swings. Swing trading requires patience and a good understanding of technical analysis. Position trading is a longer-term style where trades may last for months, and it is closer to investing but still based on trading principles. Scalping is another style where traders make many small trades within a short period, aiming for small profits that add up over time. Each style has its own risks and rewards, and there is no single best style for everyone. To trade successfully, traders use analysis to make decisions. The two main types of analysis are technical analysis and fundamental analysis. Technical analysis focuses on price charts, patterns, indicators, and historical data to predict future price movements. Traders who use technical analysis believe that all necessary information is already reflected in the price, and by studying charts, they can identify trends and opportunities. Common tools in technical analysis include support and resistance levels, moving averages, trend lines, and indicators like RSI and MACD. Fundamental analysis, on the other hand, looks at economic data, financial statements, news, and events that can affect an asset's value. For example, in stock trading, fundamental analysis may include studying a company's earnings, revenue, and management, while in forex trading, it may involve interest rates, inflation, and economic reports. Many traders combine both types of analysis to make better decisions. Risk management is one of the most critical aspects of trading, and it is often the difference between long-term success and failure. Trading always involves risk because prices can move in unexpected ways, and no strategy is 100% accurate. Risk management means protecting your trading capital by controlling how much you risk on each trade. This usually involves setting a stop loss, which is a predefined price level where a trade is automatically closed to limit losses. Another important concept is position sizing, which means deciding how much money to invest in a single trade based on your total capital and risk tolerance. Successful traders focus more on managing losses than chasing profits because they understand that losses are part of trading, but they must be controlled. Emotions play a major role in trading, and many beginners underestimate their impact. Fear and greed are the two most common emotions that affect traders' decisions. Fear can cause traders to exit trades too early or avoid good opportunities, while greed can lead to overtrading or holding losing positions for too long. Emotional trading often results in poor decisions and losses. That is why experienced traders follow a trading plan, which is a set of rules that define when to enter a trade, when to exit, how much to risk, and what strategy to use. A trading plan helps remove emotions from decision-making and brings consistency. Discipline is required to follow the plan even when emotions try to take control. The role of technology in trading has increased significantly in recent years. Online trading platforms provide real-time price data, charts, indicators, and execution tools that make trading more accessible than ever. Mobile apps allow traders to monitor and manage trades from anywhere. However, this ease of access can also be a disadvantage because it may encourage excessive trading without proper preparation. Beginners should focus on learning and practicing before trading with real money. Many platforms offer demo accounts where users can trade with virtual money to understand how markets work without financial risk. Using a demo account is an important step in building confidence and skills. Education is a continuous process in trading, and markets are always changing due to economic conditions, technological advancements, and global events. A strategy that works in one market condition may not work in another. That is why traders need to keep learning, adapting, and improving their skills. Reading books, watching educational videos, studying charts, and analyzing past trades are common ways traders improve their knowledge. Keeping a trading journal, where every trade is recorded along with reasons and outcomes, can help identify strengths and weaknesses and improve performance over time. Another important aspect of trading is understanding market psychology. Markets are driven by human behavior, and price movements often reflect collective emotions like optimism, fear, and uncertainty. Understanding how other traders may react to certain price levels or news can give an advantage. For example, when prices rise rapidly, many traders may become overly optimistic, leading to overbought conditions, while sharp declines can create panic selling. Recognizing these psychological patterns can help traders make better decisions and avoid common mistakes. Trading also requires realistic expectations. Many beginners enter trading with the hope of making quick and large profits, but this mindset often leads to disappointment. Consistent profitability in trading usually comes slowly and requires time, effort, and experience. Small, steady gains combined with controlled losses are more sustainable than aiming for big wins with high risk. Successful traders focus on long-term performance rather than short-term results. They understand that losing trades are part of the process and do not let a single loss affect their confidence or strategy. In conclusion, trading is a skill-based activity that involves buying and selling financial assets to profit from price movements. It offers opportunities but also carries risks, and success depends on knowledge, discipline, risk management, and emotional control. Trading is not gambling, and it should not be treated as such. Those who approach trading with patience, a willingness to learn, and a structured plan have a better chance of achieving consistent results over time. For beginners, the key is to start with education, practice responsibly, and focus on building skills rather than chasing quick profits. Trading is a journey, and with the right mindset and preparation, it can become a valuable skill in understanding financial markets and money management. As traders move beyond the basics, they begin to realize that trading is not just about charts or buying and selling at the right time, but about building a complete system that works together in real market conditions. This system includes strategy development, market selection, timing, risk control, and personal discipline. One of the first advanced concepts traders learn is market structure, which refers to how prices move in trends, ranges, and reversals. Markets do not move randomly all the time. They often follow patterns where prices make higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. Understanding market structure helps traders decide whether they should look for buying opportunities, selling opportunities, or stay out of the market. Trading against the market direction without strong confirmation often leads to losses, which is why experienced traders always respect the overall trend. Liquidity is another important concept that plays a major role in trading, especially in fast-moving markets. Liquidity means how easily an asset can be bought or sold without causing a large change in its price. Highly liquid markets, such as major forex pairs or large-cap stocks, usually have tighter spreads and smoother price movements, while low-liquidity assets can experience sudden spikes and drops. Smart traders prefer liquid markets because they allow better trade execution and lower trading costs. Closely related to liquidity is volatility, which measures how much and how fast prices move. High volatility can create big profit opportunities, but it also increases risk. Traders must adjust their strategies based on market volatility, using wider stop losses or smaller position sizes when price movements are aggressive. Another advanced aspect of trading is understanding different order types and how they affect trade execution. A market order is used when a trader wants to buy or sell immediately at the current price, while a limit order is placed at a specific price and is executed only if the market reaches that level. Stop orders are commonly used for risk management or entering trades when price breaks a certain level. Knowing when and how to use these orders helps traders avoid unnecessary losses and slippage. Professional traders often plan their trades in advance, deciding entry, stop loss, and target levels before placing any order, which reduces impulsive decisions. Trading strategies become more refined as experience grows. Instead of randomly entering trades, traders focus on high-probability setups that meet specific conditions. These setups may include breakouts from strong support or resistance levels, pullbacks in a trending market, or reversals confirmed by multiple indicators. The key idea behind any strategy is consistency. A trader should use the same rules repeatedly to measure performance accurately. Jumping from one strategy to another after a few losses is a common beginner mistake and often prevents real improvement. Successful traders understand that even the best strategies have losing trades, and results should be judged over a series of trades, not just one or two. Time management is also a critical part of trading that many people ignore. Different markets and strategies require different levels of attention. Some traders can only trade for a limited time due to studies or work, so they choose higher time frames like daily or weekly charts. Others may prefer shorter time frames if they can focus on the market for several hours. Choosing a trading style that matches one's daily routine helps reduce stress and mistakes. Overtrading, which means taking too many trades without proper setups, is often caused by boredom or the desire to recover losses quickly, and it usually leads to poor results. Another major factor in long-term trading success is understanding trading costs. These include spreads, commissions, and sometimes overnight holding fees. While each cost may seem small, frequent trading can make them add up significantly. Professional traders always consider these costs when calculating risk and reward. A trade with a small profit target but high costs may not be worth taking. This is why risk-to-reward ratio is so important in trading. A common approach is to risk a smaller amount to potentially gain a larger amount, such as risking 1 unit to gain 2 or 3 units. Over time, this helps traders stay profitable even if they win only a portion of their trades. Psychological growth is one of the hardest but most important parts of becoming a successful trader. As traders gain experience, they learn to accept losses calmly and avoid emotional reactions. They understand that losses are business expenses, not personal failures. Confidence in trading does not come from winning every trade, but from trusting the process and following the plan. Many traders struggle with revenge trading, which happens when someone tries to immediately recover a loss by taking impulsive trades. This behavior often leads to even bigger losses. Self-control and patience are skills that improve with time, reflection, and discipline. Real-world events also have a strong influence on markets, and traders must be aware of this connection. Economic news, interest rate decisions, company earnings, and global events can cause sudden and strong price movements. Some traders prefer to avoid trading during major news events because of unpredictable volatility, while others specialize in news trading and prepare for these moments in advance. Understanding how news affects different markets is essential, especially in forex, stock, and crypto trading. Ignoring major events can expose traders to unnecessary risk. With experience, traders also learn the importance of adapting to changing market conditions. Markets can shift from trending to ranging, from calm to volatile, and from optimistic to fearful. A strategy that works well in one environment may perform poorly in another. This is why flexibility is important. Adaptation does not mean constantly changing strategies, but making small adjustments while keeping the core rules intact. Reviewing performance regularly helps traders identify when adjustments are needed. In the long run, trading becomes more about personal development than just making money. It teaches patience, discipline, decision-making, and emotional control. Many traders say that trading reveals their strengths and weaknesses more clearly than any other activity. Those who commit to learning, practicing, and improving gradually increase their chances of success. Trading is not an easy path, but for those who approach it seriously and responsibly, it can become a valuable skill and a deep understanding of how financial markets operate in the real world.